Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. Today I would like to present about the influence of institutional ownership, audit quality, profitability, and leverage on tax avoidance. Case of listed property and real estate companies in ETX period 2016 until 2020. Before I start my presentation, let me introduce my team behind this research. There was me, Alvia Putri Winda Anggianti, and Mrs. Sartika Wulandari. We are from Stikubank University. On the first slide, there is introduction. Tax is a source of revenue that has an important role for a country. There are two important functions of taxes in improving the country's economy. The first one is to finance expenditures, and the second one is a tool in regulating government policies in the social and economic fields. The results of tax collection received by the government are used for state financing and national financing. But the realization of tax revenues in Indonesia hasn't reached the target set by the Minister of Finance. Currently, Indonesia is being aggressive in terms of carrying out development. The property and real estate sector is one sector whose growth continues to increase. The phenomenon of tax avoidance cases has occurred, which is in property company namely PT Agung Podomoro Land. This case occurred in 2016 and stemmed from the leaking of 11.5 million documents known as the Panama Papers. The Panama Papers state that PT Agung Podomoro was once involved in tax evasion assisted by the law firm Mossack Fonseca. This is the table of target and realization of tax revenue in 2016 until 2020. Based on the table, it can be seen that the realization of tax revenue during 2016 until 2020 hasn't reached the target. Tax avoidance is a plan made by taxpayers to avoid taxes legally because it doesn't violate the law. This is from Juliana 2019. The technique used in tax avoidance is to take advantage of the weakness contained in the law and taxation. Tax avoidance can be influenced by several variables, including institutional ownership, audit quality, profitability, and leverage. On the first one, there is institutional ownership. Institutional ownership is the percentage of shares owned by institutions with ownership above 5%, or fraud and reports them in the audit financial statement. The auditing process really requires the attitude of transparency, professionalism, accountability, and integrity. Profitability. Profitability shows that the company has high profit as well. A high profit can be used as a benchmark for a management performance. The last one is leverage. Leverage can be interpreted as a form of a company's performance in using assets that have fixed expense properties to increase the company's profit. Move to the next slide. There was literature review. Agency theory is a theory that explains the relationship between people who manage the companies, or we call it agents, and the business owners or principals, both of which are bound by a contract. The hypothesis development we got, the first one is institutional ownership. Agency theory, the relationship with institutional ownership is when a high level of ownership of a company tends to reduce agency conflicts between shareholders as principals and managers as agents. This means that with institutional ownership in this company, the supervision of management performance is getting higher. The second one was audit quality and tax avoidance. The relationship between agency theory and audit quality, namely agency theory can help auditors as third parties in the understanding conflicts of interest and can solve a problem between shareholders as principals and managers as agents. Audit quality is often seen based on the size and reputation of an audit firm. Audit firms classified by a Big Four have a better audit quality and the non-Big Four The financial statement of companies audited by Big Four have a lower level of fraud than those audited by non-Big Four. On the third one, profitability and tax avoidance. The relationship between agency theory and the profitability is where the management as agents of a company tries to increase company profit so that the income tax burden will increase in accordance with the increase in company profit. While from the tax authorities as principals want as much the revenue as possible from the community. With this difference in interest, it will lead non-compliance with the tax payment, which will have an impact on a company's effort to avoid tax. This shows that the higher received profit by the company, the higher the tax burden, so the company tries to minimize payment. So profitability has a positive effect on tax avoidance. The last one was leverage and tax avoidance. The relationship between agency theory and the level of debt is where the management, as an agent who runs a company, acts to take risks in borrowing capital and tries to make the company's debt look productive, while the shareholders, as principals, will give more confidence to the manager. Thus, the company will use debt as a source of funding because it will cause interest expense. Dependent variable and independent variable. The dependent variable or variable Y in this study is tax avoidance. This is using PTD or book tax difference. This formula is taxable income minus net income divided by total asset. The first independent variable is institutional ownership. This is using KI. The formula is institutional owned shares divided by total shares outstanding. The next one is audit quality. This is using a dummy variable. The one score is given to company that audited by the Big Four. Whereas if a company is audited by a non-Big Four, it will be given a value of 0. Profitability is using return on asset or ROA. The formula is net income after taxes divided by total asset. And then the last one is leverage. Leverage is using the debt to equity ratio or DER. The formula is total liabilities divided by total equity. The next slide is method of analysis. The method is using quantitative. For population, this is listed property and real estate companies. And for sample, using purposive sampling, that data were 42 companies. Data using descriptive statistical analysis and data analysis method using panel data regression method. There are three techniques that can be used to estimate the panel data regression model. There is common effect model or CEM, fixed effect model or FEM, and random effect model or REM. The selection of panel data regression analysis estimate can be done by performing the F-test, in which there are three models. Among the three models, the Chow test and Hausman test were carried out to determine which approach was more appropriate. This is the table of result descriptive statistics. The table shows sample data in the form of mean, median, maximum, minimum, and standard deviation. On the right is Chow test. In this study, the result of Chow test have a probability value of f 0.00, meaning that the model chosen is the fixed effect model, meaning that HO is rejected and HI is accepted. Then the Hausman test will then be carried out to determine the fixed effect model or random effect model. And on the right is Hausman test. In this study, the result of the Hausman test have a probability value of f of 0.1127, meaning that HO is accepted and HI is rejected. Then the regression technique used in the random effect model compared to the fixed effect model because it has correlate with one or more independent variable. Based on the result of random effect model, it can be seen through the p-value from the regression result with a significant level of 95%, alpha 5%, the institutional ownership variable obtained a coefficient of minus 0.001664 with a p-value of 0.7659. The audit quality variable obtained a coefficient of 0.0002 with a p-value of 0.956, and then the profitability variable obtained a coefficient of minus 0.015 with a p-value of 0.05, and the leverage obtained a coefficient of 0.000 with a p-value of 0.702. All the variable value is more than a significant level of 0.05. The effect of institutional ownership on tax avoidance. Institutional investors are able to carry out supervision properly because they have more resources compared to other shareholders. Thus, institutional ownership in companies encourage more optimal supervision of the performance of company management. However, the results show that institutional ownership has no effect on tax avoidance, so that the large or small percentage of share ownership hasn't optimally influenced the company's management decision. Then, the effect of audit quality on tax avoidance. Audit quality is often seen based on the size and reputation of a public accounting firm. Audit firm classified as Big Four and non-Big Four. This based on the idea that the Big Four have more partners than the not-Big Four, as well as the various audit capabilities provided and competitive quality audits compared to the non-Big Four. However, tax avoidance practice can occur regardless of whether audit by Big Four and non-Big Four. The company can influence the auditor by giving the lure of obtaining welfare and profits for the public accounting firm. So audit quality has a significant effect on tax avoidance. Then the effect of profitability on tax avoidance. The profitability earned by the company doesn't affect the practice of tax avoidance. The higher the level of profit obtained, the higher the net profit received. Companies with high profit levels allow companies to pay taxes that have been charged. The last one is effect of leverage on tax avoidance. Leverage that owned by the company doesn't affect the practice of tax avoidance. Interest expense, which is used to reduce taxable profit, is interest expense arising from loans to creditors who have nothing to do with the company, so that the high level of debt in the company makes the company management more careful about the debt they have. The higher the debt owned, the higher the interest expense they must be paid. So the leverage has no significant effect on tax avoidance. The last one is conclusion. So institutional ownership, audit quality, and profitability and leverage has no effect on tax avoidance. That's all for the presentation today. Thank you very much for your attention.